Hi. So from an asset allocation perspective, we've gone a little bit more defensive. We rotated a little bit more towards value. Obviously, technology and growth worked very well last year. That served our funds very well. But through this year, we've bought more financials. We've reduced technology. And then specific to your comment on, ASEAN and some of the weaker currencies, we are cautious on Indonesia. I think that the actual absolute level of debt to GDP is not that high. It's only around 70%. But the issue is the FX reserves and the external debt. So we're more cautious on Indonesia than we are, say, the Philippines, where we think that the domestic story is stronger. The current account deficit is much lower than it is in Indonesia. And the domestic economy is actually quite buoyant.
EM direction ultimately hinges on dollar direction. So which camp are you in then, Andrew? Is it dollar remains stronger for longer as long as this US growth exceptionalism story remains intact? Or should we be talking about peak dollar right now?
I think somewhere in the middle. I think, as you can tell from my positioning, that we're cautious. That would imply that the next few months we would still expect that emerging markets are going to be under a bit of pressure. But I think when we do get into next year or even the end of this year, I think markets are then going to look forward. They're going to look forward to peaking of interest rates in the US. But I think importantly, with the trade tariffs and the concerns, the markets have reacted ahead. But actual export numbers, etc., are actually very strong. So it's only going to be 3-6 months' time that we're going to see the economic impact of the tariffs, and that's going to hurt the US just as much as it's going to hurt some of the Asian economies and China. So once you start seeing that data feed through, then I think people would be starting to question the direction of the dollar, and perhaps we're going to see a flow back towards Asia and emerging markets.
Especially if those tariffs manifest themselves in the form of higher prices and an inflation overshoot. Hadley has a question.
Andrew, how should emerging market economies really be reading this decision? Because essentially you had the chairman of the Fed coming out and saying, we are sensitive to what our decisions mean for these emerging markets. At the same time, of course, we're focusing on the domestic economy. So we care, but, at the same time, we really don't. The question, of course, is a country like Turkey, for example, how should they read this going forward? Because they're in a pretty precarious position at the moment.
Well, again, I would be emphasising how, Asian economies look in much better shape than the likes of Turkey or the likes of Argentina. So I don't really buy into this contagion argument for emerging markets. I think, specifically to answer your question, I think they're looking more at the domestic economy, but they're also looking at defending their currencies, because most of the pressure this year within Asia has been on the currencies. Yes, Indonesia and the Philippines, the stock market has been relatively weak, but we haven't seen dramatic falls. So I think that they're looking at the weakness of the currency to support that currency, and therefore, the likelihood is they're going to increase interest rates, and consensus is for both the Philippines and Indonesia to increase interest rates at their upcoming meetings.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.